So I color coordinated my time frames. Uh, so 1 hour is yellow, 30-minute white, 15 is peach, 5 is gold, 1 is purple. So if it closes in any of those, skipping after light job data, yeah.
At the CEO Council, he talked about sports. Yeah, David, the
So
NFL is in play here.
get my
Apparently for
Robin
Apple.
Hood.
So
who reported that, Jim? Where is it?
this is an Evercore piece.
Yeah.
I don't know what he's doing. He's speaking positively about Apple. I don't know what that's about because it's certainly not warranted today. But we're talking about ESPN currently paid. We're talking about ESPN. They said that Apple bid for the NFL Sunday night ticket. David, who is that? Who has the Sunday night?
Wow, that's pretty low. 18. Down 2K.
We do, Jim.
Wow, did you see our ratings this past Sunday night?
Larger NBC family, biggest ratings since the Super Bowl.
Well, because I
Taylor
know.
effect.
I don't know who the quarterback is, but boy, what a tight end they got.
Yeah, although he did not have the greatest game.
Price going
Well,
up.
pretty decent game. Amazing for a QB.
All right, I got to
forget about the NFL.
But that's
bearish
value gap.
When it comes to sports rights, it is not unimportant. Although the NFL is the least of it at this point, many of the deals are still in place for quite some time to come. The NBA contract is nearer term. There are some questions, but when it comes to Apple, and by the way, this is.
That's
it
the
has
1
virtually nothing to
hour.
do with the fundamental underpinnings of the stock. But when it comes to the Apples, the Amazons of the world, the real question is, do they really want to become more robust in terms of their sports programming, what they have available?
Right here is
Talk a lot about
something.
Messi, but it's not going to move the needle that much. And even the question is, even for them, whatever they spend wouldn't move the needle that much for Apple or Amazon, but of course could crush those who rely on these deals to generate real numbers. Now,
I
by the
don't
way,
know
when it
anything
comes
right
to
now.
TV, people basically at this point are talking about TV is really just the NFL. That's all it is at this point. Either you got it or you don't.
Order
If you
block. I
don't,
think
then
that
you're not
may
really in the TV business.
be order block.
You're right.
That's why I highlighted it. So my regular, just my regulars, I'm gonna make it light
The
blue.
households watch. For instance, I haven't seen the numbers for ESPN and all the baseball games last night, but they probably all together don't add up to Travis Kelce and Swifties.
Rising.
Philly had a nice, at least early part of the game that I saw, right?
Yes, we had a very good game, but I don't know how many people care about it. I think they care more about the refiners going down. The oil, by the way, oil peaked.
It can go up to 426, 425, so
was that just all
426.
for show? When we talk about oil every day driving the bond market,
Energy,
for show.
energy, the only sector
Keep
red
that
this
one
morning.
open.
OPEC,
Marathon peak.
the OPEC meeting has no real change in policy. We got to 87.32. No, now 86.73. Jim, that's going to take you back to early September.
Yeah, I mean Chevron went up not
I
nearly as
wanna
much as
watch
oil
this
when
one, so let's
oil
do
ran,
this.
and now it's going down harder than oil coming down. But I think, David, we often make these linkages that we then don't talk about when they're wrong. We did say that the 10-year was marching to the beat of oil. Now oil is getting crushed, but no one talks about how the 10-year, that maybe that linkage wasn't
And that's
as
there, that gap right under what I believe may be an order block.
Oh, you're not a linkage guy, maybe?
No, I didn't see the head and shoulders. I didn't see the linkage.
So that gap will have to be filled.
You know, what we will continue to come back to when it comes to the bond market and the 10-year in particular.
But it may not be filled today. It may be filled a different day.
That is a new
Alright,
normal
5
that we're
minutes.
going to be
That's the
dealing
1
with.
hour.
Funding these deficits, and whether the Japanese are not there any longer, the Chinese are not there any longer, and how we're going to distribute the supply successfully, and what interest costs are going to actually mean as a percent of GDP. That's what we're going to be talking about. Those are the linkages that I think we're looking for here.
So you're being substantive in making these judgments, as opposed to being facile.
I suppose. I'm trying.
There goes David once again. You know, I don't want the facts to get in the way of the story, so I went with, David is right. It is supply and demand. And David, by the way, there are a lot of people who come on and they make these, what I really do say, facile statements. I want to know, there's the biggest short position in history in the 10-year. How many of the people who are calling for apocalypse now, are they short the 10-year? And shouldn't we ask them?
I know. It's one, in fact, one knowledgeable, one sort of somebody I speak to regularly said to me today, when Bill Ackman comes out and takes one last victory lap, because he has been short at the long end here, that'll be the time. So let's wait for that.
Or, as you suggested this morning, Jim, maybe Moody's doesn't follow through with the downgrade, or
Right.
maybe the Europeans start getting interested in our paper
Well, yeah.
while selling their own.
I mean, the Germans do have money, right? Why don't the Germans buy ours and short theirs? And the dollar's been great. We always focus on Japan. Japan, no growth environment. They should do what they're doing. China is we have no idea what China's up to. I mean,
That's actually a big debate as to
Yes.
if whether or not they are actually recycling less.
We are in
There's
the
all sorts of
yellow,
takes this
so
morning.
yellow
by the way, the
is
Chinese economy,
1
there
hour.
are signs that say that it's doing better. What's interesting is maybe Xi Jinping decided, you know what, we'll crush the real estate sector, and then after that, we'll let the economy go up. And it's a command economy. Hey, David, you know, they're communist over there, and it's arguably that when they don't tell you how the 21-year-old unemployment rate is, maybe we should be saying, hold it. Maybe their numbers are not to be trusted.
Well, we've
Right.
always had that debate in terms of the veracity of the numbers coming out of China and whether they've overstated growth and things of that nature. And to your point, whether they just simply hold back in certain areas because they don't want to deliver particularly bad news.
Right.
Property sector, Jim, there continues to be, I think, the key focus given how important it is to the overall economy, particularly when it comes to the consumer and spending, which they're obviously trying to increase as an overall percentage of their GDP. I don't know. I mean, that just doesn't look great at this point in terms of property and what they're going to actually do to potentially save some of these companies and how aggressive the state is going to get in terms of doing that. Right.
Well, David, couldn't it just be a cram down? I mean, they've got a habit of defrocking the rich over there. I mean, we've got some people like the FTC. They do that, but they don't detain people, the FTC.
No, but the point is you got a lot of people who've invested in whether it's the funds that invested in property or were providing financing to these companies. You've got a lot of apartments that have been promised that haven't been finished. So you're talking about the middle class that could be hurt. And or to the extent a lot of their wealth is tied up in real estate in some way or their ownership, their willingness to spend obviously comes into question.
Well, I mean, Nike, they sold a lot of Nikes. There you go. There's the counter, David. No, I mean, David's absolutely right, but I'm looking at Alibaba. The stock does go down all the time, and maybe there is a sense that there's been some destruction of the middle class, Carl.
Citi today actually raises their Chinese GDP forecast back to 5.
From what I am looking at,
4.7. That's
that
the
is
second firm
not
down in the past
in
week or
order
two.
lock.
Tesla, of course, a lot of discussion about Tesla's China demand, the competition with BYD. I see Jonas took a crack at that today.
Yeah, Jonas is out there. David, when Jonas speaks, I know you listen because he's kind of clever and funny, but I actually asked Phil LeBeau about the oil substitution, trying to anticipate exactly what Jonas will be focused next time. But look, I think that you can do Tesla every day, David. You can do Netflix too. We didn't even talk about how Netflix is going to maybe charge more. I don't know. These are the two stocks that fascinate what we call retail, David.
Alright,
So
so
anything
now
you can possibly do about either
let's
one of them
see.
is called what we get. It's called numbers.
It is called numbers, and you're
Numbers.
right. Netflix performed fairly well yesterday.
I
in the
don't think
sell-off
this
as a
is
result
a
of the
order
belief that they are
block,
going to, at least
so
according to
this
the
can
journal,
get
raise price after
trash.
the
But
actor
then
strike is
I want to.
essentially
Oh,
settled.
why that?
Haven't
I
heard
should
any
have just done
updates on
this.
that.
What have you been watching on Netflix?
You've got companies that are levered, guys, like Warner
This
Brothers
right
Discovery
here.
that continue to trade down.
You mentioned NBA, David.
Because
That
if you-
has to be
NBA
filled
too, but if
in.
you've got any near-term refinancings coming up, and you got to hit the bond market in a real way, it's not a pretty picture, is it, Jim?
No, and that's one of the reasons why Macy's, when I spoke to the two gentlemen, Jeff Unit and Tony Spring, the soon-to-be out CEO and the soon-to-be new CEO, that stock is down a lot because there's concern about the credit card, but also, Carl, they have debt that comes due 27, 28. All these guys would tell you, I think, David, you'd admit it, that Dave Zaslav has made it so the short-term maturities in the next year and a half are not so bad.
True.
Like nothing.
And I'm glad you pointed that out, because that is the case. But it doesn't mean that investors aren't screening for that kind of stuff and looking and seeing in terms of the capital structure
Absolutely.
and when refinancings are due. It's just overall, when you're talking about close to 5% 10-year, that is going to change the, the needs.
You haven't mentioned Verizon or AT&T. Is there a reason why you've left them out from? Why is he?
Well, yesterday, as you know, you surprised me. I did not notice, I guess, the decline in Verizon stock price, which has resulted in its dividend yield being 8.5%.
Don't you think that's a red flag, Carl? When I see a dividend that's at 8.5%, a yield at 8.5%, I say to myself, red flag.
Is it though, Jim? Is it a red flag? I mean,
Yes,
there's
it's a
nothing
red
that says
flag.
that they don't have the ability to continue to pay that dividend.
Well, yes, but I think historically, it doesn't matter what company. If you see a company that has a yield that's far in excess of everybody else, I mean, let's say this were one of the great blue chips and it had that yield, I would say, okay, well, that's a bit of a red flag. I'm a bit of a red flag. Bit of a red flag.
Support level will get violated by the next up close candle.
Speaking of, all of this discussion reminded me, Jim, of when you were trying to get the government to issue 50-year paper.
Yeah, they laughed
that would have been a deal, right? That would have helped the maturity
they all
wall.
laughed, not unlike what Carrie said about John Travolta. They all laughed, and you know what? Oh, hand from the grave, David. You know what? It's a Carrie mark. I actually went to every one of the so-called big muckety mucks in Washington, and they thought it was funny. They thought I was funny.
They did.
You know, like Louis C.K. funny.
So another one of those big ideas that nobody listened to.
Yeah, like Sam Kinison. They thought I was Sam Kinison.
Disney Park in New Mexico.
In New Mexico, you had 300,000 acres created the other day, and there's some. And by the way, there's some.
Alright, so
Yeah, what else, Carl?
They all
How many have they
Let's
laughed
do
at through the
this.
years of these big ideas that Jim
Well,
spends
they
a lot
think
of
I'm
time working on?
They think I'm a genuine Wall Street funny man.
Let's see, we got services PMI crossing the tape this morning. Let's get to Rick Santelli. Hey, Rick.
Hey, good morning, Carl. Yes, these are the final reads. So we replaced the mid-month read. Mid-month read for the services on S&P Global PMI was 50.2. It gets downgraded to 50.1. That is the weakest since January when it was under 50 at 46.8. On the composite, the other direction. 50.1 becomes 50.2.
alright, so I have this on my big screen so I can keep an eye on
we
it.
see that interest rates are down. I guess the best way to describe today is that we're at 4 3/4 and a 10, and yet it's down.
So let me see what he said.
5 basis points from its 5 o'clock Eastern cash close. It's been up nearly over 480, and the long-term horizon is until somebody gets interested in those yields from a purchase standpoint. Liquidity issues probably continue to make selling have a bigger move to the upside than the lack of buyers to any moves to the downside. Squawk on the Street will return.
Stop loss. Alright. Alright, so let's see. The day right now, we are bullish. And the 1 hour bullish. 30-minute bullish. So we enter in the range of my 1 looks white or my 15. My 1 definitely my 30 or my 15. So that's the order block from that one. Hello, abstract remediation. Michael speaking. Yeah, where are you calling from? I don't do work for you guys. Bye.
Peacock. Oil lower generally means some positive arrows for the transports, and indeed, the airlines are close to the top of the winners list today. Didn't really mention the UAL plane order for 50 more 787s.
That was significant.
So you'll see Boeing on that list, although not as much. Dow is down despite that Boeing action, about 13 points. We'll get stopped trading with Jim in a minute.
So these are stop because external or internal. So that's gonna be a high for the day. Minutes. So 15 minutes. We are now in a bullish, bearish. I mean, no fair value gaps, but I think if it hits that, it's gonna go up. So I'm gonna do a small bet. We have 425. Just leaving one. Because I feel it looks like it's going to fill that in. And then so we have that gap at the bottom, and then we have the fair values at the top. So let me go back here. Okay, but why? Okay, here we go. We're leaping. All right. What happened? Oh, here we go. So I feel like if we fill in that gap, it's filled in, and it needs to go one way, up or down.
One thing we haven't gotten
I feel
to
like
is this
if it
strike
goes
by
up,
some
we're
Kaiser
going to
workers,
go up for
about
a while.
75,000 across several states.
If it goes down, we're going to go down for a while.
13 million customers in that time.
It's an unbelievably good. I've had their insurance. It's an amazing company, and
So there we go. We have a fair value gap.
Visible than say a writer's strike. in people's daily lives. And look,
If it
there's a lot of
closes
people who
in
feel left
that,
out
we're good. And
and
then
have not had the big wage gains.
this
It's
looks like
not
a
what the Fed
breaker
wants
to
to see, but
me.
certainly people don't make a lot of money. They
What
should make
is
more money.
it?
Expected to last about 3 days. And to your point, Jim, a lot of the union wages, the auto's a good example where that hasn't kept pace
No, it
with
hasn't.
So,
non-union
yeah.
wage work.
Right, which is why
Right here.
certainly they have every reason to strike. I think they just have to be careful whether the companies have enough money to pay. That's all.
That's-
The car business is very simple.
Kind of brings us
And
to
we
a
already
flash head
closed
about,
in that fair
GM
value
today
gap,
preparing a
so
$6
it was
billion
price was
credit
violated.
line, to cushion some strike costs. Jim,
And
the
when
read there is
this
that
one
maybe
too,
they're girding for a longer strike than some think.
Well, a lot of people feel that the union only has 5-week strike funds, so you can imagine that, David, these people are not playing with. These people are playing hardball now. Ford's got 5 months. This is not going to be. The Sean Fain is running out of room here.
2 days on jury duty for you, dealing with sort of the strains that regular people are under, and it's a kinder, gentler Jim Cramer when it comes to labor stoppages.
Yeah, I'm
Really? Is that all it took?
patronizing it. Yeah, when I'm with real people, it's quite versus my rarefied people in Summit Bog. I found out that real people aren't making nearly as much money, Carl. They're all living in their cars like I did for 6 months. In my Ford Fairmont with my gun and my bottle of Jack Daniels, so I don't know Jack. Right? Brushing my teeth with Jack Daniels. She stole that from me.
Let's get to Jim and stop trading. What are you watching today?
Okay, I'm watching Chipotle, and the reason I do this is because there's a piece out by Opco, and it just basically says, listen, don't fear, everything's fine, you have to trim a little. I just pointed out because right now, there are a lot of people trying to defend stocks that kind of been drifting down.
so
And
right
Chipotle's
here,
good, but the
where
chart's
I'm
bad. I know
moving
David's focused
I don't
on the
think
chart.
is it as bad
around
as McDonald's?
422,
McDonald's has
36,
a lot of
7,
that, by the way. Look,
I
they have
feel like
franchisees.
the
You can't
green and
grow
then
if
this
you're not going to
red
get credit to be able to
is
buy a new
a
McDonald's, and the franchisees are
breaker.
unhappy. Chipotle owns
So our
its
stop
stores.
loss
That's
should
why I've always liked
be
Chipotle's model
down
more than
here.
McDonald's. But people like the model, like the McDonald's model. I like the
And
Chipotle
then
model. I also like the
we're
I want
pretty
them to bring
close
back the
to
carne asada.
lows of
It's a great
today
20-year
with
chart, right?
this
I mean, we were doing 20 years
red.
yesterday. Remember, Jim? We did.
Well, 20 years
Nvidia.
different.
So
Chipotle
if we
is
can
amazing,
close
right?
into
It's-
Chipotle
this,
spun off by McDonald's,
Yeah.
and it's one of the greatest companies on earth, and it's really well run, and I think that it deserves to sell where it is, maybe higher.
maybe it's
Dave,
accumulated
you ought to
for a
try
while.
some of the new things they've done.
Here it is. Yeah, that's a nice one.
You can only eat half and then save half, okay?
Really?
Yeah, the bowl. Eat half, save half. You don't need it all. They put too much on.
It's a lot. It's a lot of
It's a
food.
great value.
How about tonight?
Okay, so I have Molson Coors symbol tap, and I have on symbol on. And I have to tell you, these are companies, by the way, that younger people are buying. So I'm trying to get, people a little more interested in what people love the on shoe, and people drink. They drink Molson, but on has got a big analyst meeting, and Molson had it yesterday. And these are companies that are both doing very well, but they're not Nvidia. What can I say?
And when,
Nobody's
when,
Nvidia.
when do we get Constellation? Is that
That's tomorrow in STZ, and there should be a reflection. These were all because of the Bud Light frascas. They're doing
whole category got hollowed out?
Yeah, Bud Light was the largest, not anymore.
Jim, we'll see you tonight.
Fantastic,
Mad
thank you.
Money, good to have you back at
Thank you,
6 p.m. Eastern
So
time.
right now
We'll
I'm
get
up
some more breaking economic data after a quick break.
$5,
We're back
now
at
4,
2.
5, 7. So we reached down there. Let's see exactly what happens. So it was offered. All right. So if I'm right, Let's see. This should be let's just make this thicker. This should be internal lows. So I think this would be, I don't see it. Let's go here. I forget. So I'm thinking where I just marked from here to here, from 422.27 to this purple line is stop loss. So we get into there. Am I seeing anything?
Along with David Faber, who's live from CNBC headquarters today in New Jersey. Take a look at stocks after yesterday's big sell-off, brutal sell-off that left the S&P at a 4-month low. We're bouncing today up about a third of 1%. The Dow's higher by 14 points. A little bit relief on the yield side after the 30-year crossed 5%. We're 30 minutes here into the trading session. Here are some big movers
this
here
right here.
Apple getting a rare downgrade this morning. KeyBank cutting the name to sector weight from overweight, citing a number of concerns, including valuation,
which is a turtle soup, I believe,
and aggressive
if I'm
international
correct.
growth estimates. Stock is little changed. JP Morgan cuts price target on Meta to $400 per share, but maintains an overweight rating on that stock. This amid reports that Meta is preparing to lay off employees at its Metaverse Reality Labs unit today. And then Intel on the move, but off the highs after announcing plans to spin off its programmable chip business with a possible IPO for that business within the next 2 to 3 years.
Got some PMIs this morning, now some ISMs. Let's get back to Rick Santelli. Rick?
So I already know price of that was
here. Let's look at factory orders, shall we? Factory orders up 1.2%.
and when we have that, we have a fair value gap
That's the
here.
best since June when it was up 2.3, and in between we had minus 2.1, so quite a comeback, one might say, averaging out some of those months. Transportation 1.4, that's the best since March of 22. And if you look at durable good orders, these are the final reads, Carl. We take the mid-month reads out. Mid-month read at 2/10 now becomes 1/10. Transportation remains up 4/10.
Now I know that
if you look at
gap has to be filled.
Non-defense Air, a proxy for capital spending, it remains a juicy up 9/10. And finally, shipments remain at up 7/10. Now, here's the big numbers. ISM services on the PMIs, 53.6 on the services index. 53.6 actually is the weakest since July.
Wow.
It was 52.7.
That's definitely
in between, we had a very solid 54.5. But that's all pretty good because every month this year was above 50. We haven't been below 50 in contraction mode since December of last year. If we look at the prices paid component, 58.9, which equals our last look, and it's unfortunate because both those numbers are the highest since April. We've had numbers in the 54s in between, so we'd rather see obviously prices paid remain more tame.
Fair
on the
value
services,
gap.
Employment front, 53.4. Well, that actually is the weakest since 50.7. That was in July because we had another solid month in August. And finally, on the new orders front, 51.8. And 51.8 is on the weak side. We have to go back to the end of last year to find a weaker number, and that number happened to have been under 50. We see interest rates remain lower on the session, but much higher on the week. Sarah, back to you.
that has been the story. Rick Santelli, Rick, thank you. And overall, guys, if
I
we look
don't
at some
think
of the
this
data that Rick
actually
said,
worked.
good for
So
the
let's
markets
remove
for it to
that.
come in on the weaker
And then we
side of
have this.
expectations, but it's still showing maybe a little too much strength for comfort. And I think we should dive into some of the other numbers that we got today on jobs, because the labor market is key to this story. The Federal Reserve has wanted to see at least the labor market weaken enough to calm down wage inflation, but not so much that we have a stress or a spike in unemployment. So we got the ADP report today, which gives the sector of private jobs hired 89,000. That was a lot weaker than expected, and it was the lowest in a while.
Because if that's what
hard to
so we
square
know
that,
it goes down.
David, with the JOLTS report, what we got at the same time yesterday, where we saw 9.6 million job openings. And so I think it's worth diving into for a moment. A lot of economists this morning are poo-pooing the JOLTS report. I just got off the phone with Tom Porcelli at RBC. He said, take the JOLTS
That's
report
5
with
minutes.
a massive
1 minute.
pinch of salt. Why? He said because post-COVID, it's come out much, much stronger than some of the pre-COVID numbers, and he thinks that survey is having a hard time adjusting. David Rosenberg, who we know has a bearish bias, was saying there was only a 33% response rate, 32% response rate on the JOLTS report. So again, not as big as, say, 70, the report before. The bottom line, Carl, is that it's really hard to get a signal through a lot of these noisy reports. We know the Fed pays attention to JOLTS. I think that's why the market paid so much attention to it yesterday. Is the job market cooling? We think so. I mean, the ADP suggests, and tomorrow's jobs report should be confirmation, or Friday's jobs report should be confirmation. And that's really going to be the key, because it is hard to tell what's happening on some of these noisy, volatile data points.
Yeah, JOLTS was pretty narrow in the areas that did rise. Kramer this morning citing paychecks, saying maybe people are posting more job openings because they feel better about potential supply, meaning people are back looking. Maybe that's when you start, whereas before you sort of given up hope. And as for ADP, I mean, no lack of notes today saying that data set is unforecastable. It's not changing our number for Friday, where I think the estimates are still about 150, right?
Exactly. And so they're kind of poo-pooing both of the reports when it comes to figuring out what's going on. You know, one really big discrepancy in both data points is that the biggest job losses in the ADP report came from professional and business services. Think legal services, architecture, accounting, that sort of thing. Guess what? It was one of the biggest job openings post in yesterday's JOLTS data at 500,000. So that just shows, David, that there's some noise here. There's professional and business services. That's what happened. That was a drag on today's report. So it's hard to know what to make of the overall number. The expectation for tomorrow, I've seen estimates between 150 and 170,000 payrolls. And Carl, that's down from the 187 increase in August. I think the wage number is going to be very important as well when it comes to the labor market, because that's what the Fed obviously is targeting on the inflation front. And you know, we have this new strike happening with the healthcare workers in California.
3 days.
So
You do wonder what's going to happen with wage growth as a result of all these strikes. These are thousands and thousands of employees.
Yeah, I mean, ADP did say 12 months of consistent deceleration in wages, still up by 5
Is
plus,
that?
I think, in ADP's view. It was interesting, David, to hear, I guess, optimistic net, maybe some would say Pollyanna, but optimistic things about the percent of GDP that's paid to service
So
the
this
debt.
could have
And
been
the idea
a
that higher for longer, in her words, not necessarily a given.
a false breakout.
I think we have that sound from the
Well, we're going
secretary.
to listen to the sound there, Carl. That's why I was pausing.
Have been surprised that the U.S. economy has shown so much resilience. Consumer spending remains strong. Investment spending is solid. Housing is usually clobbered by tight monetary policy, and it has been, but it's stabilized and seems to be moving up. And so I think people are trying to figure out exactly what it's going to take to keep inflation moving down, and the economic resilience that they see maybe suggests higher for longer, but we'll see. And I think it's by no means a given.
So I think that she's, you know, David, maintaining the positive tone around the economy, the soft landing story, the fact that the bond market is reacting to the Federal Reserve. And you remember I mentioned her a few weeks, not that long ago, about the deficit and the concerns about supply and and demand on treasuries, and she
Yes.
really did dismiss it.
Let's do
Remember when I
this
asked
so
about the high
fast.
deficit, she gave a different metric, right? She said it's important to watch the U.S. interest costs as a share of GDP.
They want to
And so
cancel
here's a
that?
chart today about what is set to happen to the U.S. interest costs as a share of GDP. She wasn't worried about it because if you could see the little blue line there where it is right now, we're still under 3%, so not bad, not out of the ordinary. But the orange line in the middle is where Goldman Sachs expects it to go, and that is to a record high by 2025, a peak. The top line shows what would happen if rates stay where they are right now. The bottom line, the white one, shows if we go back, if the Fed cuts all the way down to the zero bound. It's still set to rise. And there's the forecast. And what does this tell us? This tells us that the U.S. has a government, U.S. government has a supply and demand challenge. And the cost of servicing our debt is going up and is on track to hit a record. And that's problematic.
Yeah, I mean,
Wait,
Sarah,
what
they don't make
happened?
any bones about it. It's, you know, it's not about the data set, they say in that same report. The inconvenient truth is the U.S. bond market has a supply and demand challenge to fund a deficit. That's from the Goldman piece that I think you just chose that, that chart from, which I looked at as well, and they were saying similar things yesterday. They seem very straightforward about it. You've been talking about it for weeks. If it's not about the data and it's just about supply and demand, I don't know where we are. I guess we'll look at technicals. Some people think we may still be nearing a top. We may overdo it, but who knows?
I think it all goes into it. Surely the data. I mean, yesterday we got a big jump in expectations for the November Fed meeting for them to raise interest rates. So that's definitely part of it. We're worried about inflations or flaring up again or remaining sticky. But the rate strategists, if you read them this morning, there's more to it built into the rate move we are seeing right now.
Hello, Abstract Remediation. Michael speaking. I'm not interested. Bye.
And yesterday, don't miss the forest through the trees. And the forest is we have 33 trillion in debt and a rising deficit, and this just speaks to the challenges of dealing with it.
Let's talk more about what these rising rates might mean for equities with Bob Dahl joining us this morning, Chief Investment Officer at Crossmark Global Investments. Bob, it's good to have you. Are you of the view, Bob, that that yields have separated from anything regarding inflation right now?
No, I think the bond market and the stock market are waking up to the fact that you can't have a good economy, falling inflation back to 2%, and the Fed done or almost done and going to cut rates last year. That's nirvana. It's not going to happen. It's going to be one way or the other. And then Sarah's analysis, I fully agree. For a decade, we had the deficit going up, but interest rates falling. So interest expense didn't go up. Now with the debt going up and interest rates going up, all of a sudden that free lunch we've been eating for years, we're going to have to pay the piper. You put that all together and no surprise, we're at 475.
So what does that mean for equities? And are you paying any attention to some of the 1987 analogs where it really was a picture of stocks had rallied and yields continued to climb relentlessly up until October?
Yeah, so what I would say is that
I can't move this
the
for.
probability of a financial accident certainly has gone up. When you move interest rates this far, this fast, we started to see some quality spreads widening. Look, I'm not forecasting anything. I don't know anything. But when you get this abrupt change, it often leads to that. And I think that's part of the rising required rate of return, if you will, and among the reasons stocks have gone from 4,600 to 4,200.
So how does this resolve itself, Bob? It doesn't look like we're going to get much action in Congress on that front. I mean, the Treasury Secretary isn't even seeing this as being pinned on worries about U.S. debt. So where is the resolution?
So on the government debt side, there is no
Alright, here
resolution.
we
We've got to
go.
live with this, which means slower growth, somewhat higher inflation, God forbid, higher taxes, hopefully someday some spending cuts somewhere. But they're all long-term issues, as you know, Sarah. In the meantime, the market's got to come to grips with, okay, how long can the economy stay good as interest rates are catapulting higher? Or do we have economic weakness and that dreaded word, the recession, comes back into the vocabulary? and then we have to have an earnings adjustment. All we've had so far is a valuation judgment from.
So this is not new low. So new low is
to 1819 on this
here.
year's consensus earnings. 1819 times is
So
still
let's
not
remove
cheap, as you well know.
this.
And so this
Oh,
4200 holds
let's just
if
do
the
this
economy
because that was
stays
filled
okay
in
and interest
with
rates
that
stop
gap.
going up. But if the economy weakens and earnings estimates have to come down, I don't know where we're going to get a double-digit percentage gain in earnings next year. So 4200 is
That's
a
a
lot more
gap.
interesting than 4600, but I think the risk is sadly still to the downside.
So where are you along here, Bob?
So I want to own companies that have earnings predictability, earnings persistence, good cash flow, reasonable valuations. The HMOs are an example there. Great stocks last year, struggled this year, starting to poke their heads up again. Those kinds of names that have some economic independence, if you will.
Bob Dahl. Bob, we'll keep it a bit short today. Good to see you. Check in soon. Thanks for the time.
As we head to break, here's our roadmap for the rest of the hour. A REITs route. The group, real estate getting slammed as yields soar to new highs. Are they worth buying at these beaten down levels?
Plus, the dollar is hitting its highest levels in almost a year. More on the stocks that have the most exposure and what it may mean for those companies.
And these soaring yields making companies with big cash hoards rethink returning cash back to shareholders in the form of dividends and buybacks. We'll talk about why when Squawk on the Street continues in a minute.
I don't think none of this matters. Not for day trading. All that matters is what's going on right now. Definitely does look bearish to me. So
Athletics.com.
Yeah.
Real estate sector is down more than 20% from its 52-week high, trading well below its 50-day and 200-day moving averages. But could there be opportunities for this fourth quarter? Joining us now is BMO Capital Markets analyst John Kim. John, good to have you. Sorry I'm not there in person with you. You've had an interesting call in the past. I would assume this move
so
down
that's
recently
not
just on
turtle
rates.
soup
How do these things typically
on the
perform
5
historically
minute.
when we have the 10-year soaring to new recent highs?
Thanks, David. Yeah, it's not a great time to be a REIT analyst, let alone investor. But with interest rates going up, at the same time, demand is really slowing across most asset classes. There's just a lot of uncertainty with asset prices. So we think that's good. That needs to settle out. We need to see some kind of settlement on interest rates. I think the opportunity is really on the supply side because supply is really coming down as far as development starts across most asset classes. So we'll see that really come into fruition in 25. So 2025 looks like a really great year in terms of fundamentals for real estate.
What about the underlying financing, for example, for either new or existing developments that perhaps have maturities that are coming due, and what that may mean for the overall sector if they have to refinance at a higher rate or simply unable to? Again, I come back to offices, but more broadly speaking across the board.
It's creating a huge uncertainty in the markets, and we're seeing that in stock prices today for the office REITs. Right now, it seems like the banks are willing to work with the owners and kind of kicking the can down the road. But we need to see fundamentals improve, and I think we are starting to see that in office. The leasing environment has improved. We're starting to see more activity in places like New York and even San Francisco. So those two combinations need to come in together. But yeah, it definitely creates uncertainty in the markets today, and that's why REITs are trading where they are.
So you're saying can't get in until 2025?
Well, we'll start to look at 2025, so we might be into the REITs next year. But when you look over the next 12 months, rising interest rates, really uncertain economy, we're not really super bullish on REITs today.
Is there anywhere to hide in this sector, which has also traditionally been a safe spot, although the fact that it's a bond proxy and with all the real estate troubles doesn't feel so safe right now?
There are many companies. I think the really good thing about the REITs today versus the GFC is that the balance sheets are much better. So there are some blue chip companies with net debt to EBITDA in the 4 times range, where they could be opportunistic on acquisitions if there are distressed sales. And
Think you like Prologis as one of those?
Prologis, Camden Property and Multifamily, we like Avalon Bay. In office, we like BXP, formerly Boston Properties. All very good balance sheets. You're not going to have a lot of refinancing risk compared to some others.
When you get pushback, is it about current valuation or longer-term doubt about vacancies recovering to prior trend?
The pushback is really on deceleration.
So
Like right now,
just
demand for most asset classes are coming down. And on office, we are starting to see activity on leasing, but occupancy is not really picking up. So anecdotally, a lot of these things in office feel better, but we're not really seeing it in the numbers yet. But in other asset classes like multifamily, industrial, storage, there's other asset classes where demand is not as strong as it was earlier this year.
And what about dividend yields, John? You know, there was a time a lot of them were far ahead of the 10-year. That may not be the case any longer, although given the drop in the REITs overall, perhaps those dividends are keeping up.
Normally, you want to see the dividend yield above where the 10-year is at today, and right now it's at a negative spread. And for some companies with a lot of growth, you could stomach that. But right now, you know, we'd like to see either rates come down or growth kind of lead to higher dividend growth.
Well, I did notice BMO jacked up Q3 GDP like about more than a point yesterday, right?
And now there's a new one.
The steam engine continues to fire. John, thanks for coming in. Good to see you.
Right
Another day of
here.
fresh highs and yields for the dollar. We'll take a closer look at which companies have the most exposure to a strong dollar and what it means for them. You see almost 107 this morning on the DXY. Stay with us.
Which it was closed in. But still going down. So we have that one up there. We have that one here. Let's do this.
They're all too much more than they can show.
See, that's why I think it's. Let's try this.
Hello?
See, it was violated and it's still going down. So it's going to probably meet a new low. Alright, so is there any stop orders? So right here.
The dollar hitting its highest level since November of 2022. Obviously, Sarah Eisen knows
So this
that.
was
But some warnings of FX headwinds are ahead for companies, of course, that have big exposure.
a stop
Overseas
loss.
sales being a key part of that. I'm so excited to have Dom Chu here. I'm really here with you. You're not here with me.
So that you guys.
I'm just so excited because we actually get a chance to do something physically together here at the Telestrator.
Yes.
Kind of like what Jim would do with the Mad Dash with you guys at the stock exchange. But we're going to stay a little bit more focused from a kind of a sector industry perspective here because we are looking at this sector sort